Hello, welcome back. I'm Claudia Zeisberger, professor of private equity at INSEAD, and in this video we're diving into what I like to call the doing, the getting your hands dirty of private equity deals. Section 1, we explored the different types of private equity strategies, from venture growth, buyout, to a couple of exceptions, and now it's time to actually get practical. How do firms actually find, price, structure, and close deals? This section covers the full deal-making process, from sourcing and valuation to legal, structuring, transaction documentation. Along the way, I will also highlight a few voices from the industry, our guest contributors from various private equity firms like Navis and EQT, and others who've been in the trenches. So let's get started. Chapter 6 focuses on deal sourcing and due diligence. In private equity, deal flow is crucial. Top firms don't wait for investment banks to bring pitches to them. They build proprietary sourced strategies, proprietary deal flow through their networks, thematic research, long-standing relationships. Once a deal is in play, due diligence kicks in. And this isn't just a financial review. It is operational, legal, tax, HR, ESG, and increasingly tech-focused IP due diligence. It's a collaborative effort, pulling in specialists to validate assumptions, surface certain risks, and those risks can then be addressed through either repricing, to indemnities, or even by just walking away from the deal. So you can see here a deal funnel, as we call it, from about 800 opportunities reviewed per year in a mid-market European private equity firm, all the way to ultimately 5 deals done per year. So diligence is a conspiracy. It requires the entire team aligned and focused, says Rick Foyston from Navis Capital in one of our guest comments. Nevertheless, when done right, it will build conviction to get those deals done, to get into the companies, invest into the companies, and take them from good to great. Chapter 7, target valuation. Now, here is where art meets science, or not. In private equity, the tools are standard: comparables, precedent transactions, discounted cash flows, and so on. So standard finance toolkit. But judgment makes all the difference. The question is always, what are we really buying? Future earnings, strategic upside, or are we buying scarcity value? In early stage investing, valuation can feel more like negotiation. In buyouts, it's a multi-step process, often starting with enterprise value, deducting debt-like items, adding back cash, getting to equity valuation, and so on and so forth. Whether you're bidding for a VC startup or a mature industrial business, valuation is about more than just math. It's about perspective, because ultimately, as a private equity investor, you will be an owner of that business, of the equity in that business, for 4 to 6 years, hoping to actually achieve a successful exit then. Let's have a look at deal pricing dynamics, Chapter 8. How are deals priced and negotiated? Most private equity transactions are priced through a 2-stage auction. Round 1, firms will submit non-binding offers. Round 2 brings more diligence, access to more data in the data rooms, and hopefully a refined bid. That whole process is usually run by a group of investment bankers, and pricing isn't just about the headline number. Mechanisms like locked box or completion accounts can significantly impact how cash ultimately moves at closing. Public to private deals obviously add another layer of complexity. Regulatory approvals, rules from the exchange, shareholder communication, market signaling all come into play, and we will touch on them in the chapter. The best private equity buyers think beyond price. They structure offers that are cleaner, faster, more likely to close. And that brings us to chapter 9, deal structuring. One of PE's, let's call it superpower, is the ability to engineer financing to fit the opportunity. So this kind of puzzle piece that really fits into the company, into the risk that the company already brings to the table. In buyouts, that often means adding leverage, but it's not just debt versus equity. It's the type of debt, senior loans versus mezzanine, PIK instruments, special purpose vehicles to isolate risk and manage cash flow. So the capital stack needs to work for the deal, but also needs to be flexible enough for future exits. So it's a little bit art versus science. What's elegant here is how the structuring aligns incentives, not just for the private equity firms, but also for management and for co-investors. It's almost like choreography, not just accounting. Let's have a look at chapter 10, transaction documentation. So this is the paperwork. If you are planning to work in private equity, you should get comfortable with legal documents. From NDAs and letters of intent to share purchase agreements, each stage of the transaction needs to be clearly defined, negotiated, documented. Key concepts include reps and warranties, representations and warranties, covenants, conditions precedent, breakup fees, indemnity clauses, and so on. Increasingly, W&I insurance is being used to do de-risk deals for both sides, but this is kind of like a moving process. As one of our guest contributors points out, M&A deals are often won or lost on documentation. PE sellers want clean exits, buyers want protection, and the SPA is where those worlds ultimately meet. So, this is a wrap on section number 2. We've walked through the full deal-making process from sourcing and diligence to structuring and closing. These are the core skills of any private capital professional, any partner in a private equity firm. Please subscribe to the channel below, and I'll see you for part number 3.